Hello and welcome to the Property Trio, the podcast for the sophisticated property buyer. Before we get started, just a quick reminder that the Property Trio podcast is going live and we'd absolutely love to see you there. Join Dave, Mike and myself alongside our special guest MC, Peter, the property professor, Kalizos. We've got an exclusive live recording at Latrobe Golf Club on Thursday, the 5th of March, 2026. The spots are limited, so grab your tickets now at propertytrio.com.au or open the episode description in your podcast app where you'll find the ticket link. Okay.
Nailed that live infomercial, Cate. That was really good. Boy, you've got a future in infomercials.
How good is it that the professor's flying in from Adelaide just to be at the event?
Beautiful.
I mean, he's worth the price of admission himself.
I know. And we've got to get back to him. He rang yesterday saying, I'm booking my flights, but are we catching up earlier? And so I'll talk to you guys about that after the show. But so excited. Yeah, of course. I love seeing Pete. So let's crack into today's episode. And Dave, this is in your wheelhouse, so I'm rapt to be playing host. We're talking about debt recycling, and it was prompted by a listener question. Hunter wrote into us, I stumbled across your pod a few weeks ago, and I've been binging all the great content you've produced over the last few months. Oh, thanks for that, Hunter. He thanks us for the valuable insights, and Hunter says, I have a question about the recent episode where you mentioned the interest rate on home loans with redraws are not deductible. I've read that some people get around this by debt recycling and doing a loan split to effectively convert non-deductible debt into deductible debt. Can you cover off this topic of debt recycling in a future app? So yes, Hunter, we can. That's exactly what we're doing today. And Dave, I'll start with you. In plain English, what is debt recycling?
Yeah, look, basically in plain English, debt recycling is, we've actually taken a definition from one of the major banks, and their explanation is that debt recycling is a strategy where you gradually replace your non-deductible home loan debt with your tax-deductible investment debt. So while investing along the way. So that's it in simple terms in one sentence, and we'll spend an episode unpacking that in more detail.
Mike, how would you explain debt recycling?
Sorry. Is that the part where it's like the keywords are gradually and replace? Because that seems
so it's like just conversational. Right. Yeah, I just said that, then you go,
Just put a marker in here because this is a mess of an edit.
Let's start again. Let's just go to start. You just ask that question, Cate, again, and we'll just do it again. Yeah.
So, Dave, in plain English, how would you explain debt recycling?
Yeah, so look, we've actually taken a definition from one of the major banks, and their explanation is that debt recycling is a strategy where you gradually replace your non-deductible debt with tax-deductible investment debt while investing along the way.
So the key words are really gradually and replace. It's not about making your home loan deductible overnight. I mean, that would be great if it was possible, but it's about changing the mix of debt over time. And we, of course, know that deductible is the best kind of debt.
Well, Dave, how does it work in practice?
Yeah, so look, I'll explain how it is mechanically, because it does sound sexy. It's one of those ones where people think, oh, wow, I can turn my home loan debt into investment debt. Tell me how to do that. Feels like there's a way to gaming the system that I'm not across, but I'm sure there's a subset of society that do this and I just don't know how to do it. But
this sounds like a YouTube channel you're about to launch, Dave.
Yeah, that's right. I'm not good enough at marketing. Look, basically, mechanically, this is how it actually works. So you have a home loan, it's non-deductible. Let's say you have $50,000 sitting in offset or available to pay your home loan down by. So you put that $50,000 in to pay down your home loan, and then in an ideal world, you have an investment facility off to the side, and you go, okay, well, my home loan debt is just reduced by $50,000. I'm now going to have the same level of debt, but I'm going to invest in 50,000 from a separate investment facility and start growing my investment balances or funds or wealth, but my overall debt stays the same. So in essence, you've got $50,000 less of non-deductible debt and $50,000 more of deductible debt. And so over time, you gradually continue to pay down your home loan and then redraw on your investment loan to then go and invest and continue to grow your wealth. So your overall debt stays the same, but in essence, this concept, it's called recycling debt, because as you pay down your home loan, you don't go, beauty, I've got more debt. You go, okay, well, I'm going to take on more debt to buy investments. And so it's most often done in that sort of format with shares, because obviously shares can be done more incrementally.
So the term recycling sort of demands that we're talking about an asset that stays in circulation but is repurposed. And it could be just, let's say, a glass bottle, right? It gets recycled. We're not creating anything new. So we're talking about the same amount of debt, but just restructuring it in a more beneficial way, right? So over time, your non-deductible loan balance goes down, but the investment loan balance exit or grows. So the total debt will stay broadly the same, but the proportion of deductible versus non-deductible changes, and that's where the magic happens, right?
So, Dave, why would someone even bother doing this?
Yeah, so the strategy is promoted as a way to become debt-free years earlier than planned. The idea is to be more tax efficient while you're paying off your home loan by using investment income and tax savings to make extra repayments. That's the way it's marketed. So in theory, you reduce your home loan faster because you're also getting extra income from your investments. But the main game really is that it gets you investing regularly over your lifetime and setting up to have a nice nest egg for when you retire. That really is the key element of this. It is more often used with shares, as I've already said, because that's easy to do in small chunks incrementally.
Yeah, so instead of just throwing every spare dollar at non-deductible debt, you're also building that portfolio, as you say, Dave, at the same time. And I suppose in theory, you end up with less non-deductible debt and more deductible debt. And in concert with that, investment assets, which we all know and love. I mean, this show is kind of about that.
Yeah, well, this is where I want to slow you down because the explanations often make it sound like a no-brainer. What are the pros of this strategy? Mark, have you got any thoughts on this?
Well, as the resident tax nerd, I mean, this one speaks to me. It's tax efficiency. I mean, that's the main benefit, right? So over time, you're gradually replacing the non-deductible home loan debt with deductible investment debt, which we know. So you can't claim the interest component of your principal place of residence, but you can with your investment. So that can reduce the after-tax cost of interest, especially if you're on a higher marginal rate of tax as well. It could also get people investing earlier instead of waiting until the home loan is fully paid off, like our parents' generation taught us to do. We sort of done an episode on some of those old concepts. You're actually investing alongside the mortgage and giving those investments more time to compound.
Yeah, and the big pro people talk about is that it's supposed to help you reduce your non-deductible debt faster. But this is where I think at times it can get a bit spooky because in theory, the investment income helps with repayments. But the caveat here is that it only works if the investment is positively geared. But as we know, most investments, definitely in property, but also with shares and other forms of investing, start off negatively geared. And so you often have a shortfall. And so that is something that a lot of people may not fully appreciate when they're learning about this concept or being sold on the idea of it.
Yeah, and you've got to be...
Sorry, Mike, we all know that in a lot of cases when investors get started, the property is cash flow negative. It's not positively geared.
I'm doing a presentation for some property managers tomorrow in Sydney and using examples like local to them, like Coogee, apartments for 1.1 million, renting for 800, and sort of modeling out, well, what is it actually like? What is it like to be a property investor, and why do we do it? And it leaps off the page the extreme shortfall. So really, without capital growth, it kind of doesn't make sense. Of course, yeah, you can negatively gear, but you have to be making a loss. And I think people get too excited with negative gearing. It's like, well, that is just it's a tax outcome of an investment that is costing you money to hold on to. So yeah, we've got to understand that shortfall needs to come out of your own cash flow. So instead of helping you pay your home loan down faster, you actually have less surplus cash to put towards paying down your home loan. So that's probably the anti-spruiker comment that we need to throw in as a disclaimer.
Yeah, look, that's exactly right. And it's really important for our listeners to understand this key point. You will need to cover the investment loss and pay your home loan down more slowly in all probability. So just as a quick example, let's say you've bought an investment property in this type of recycling, and let's say, or even you've built a portfolio. You might have even built up a share portfolio through recycling over a long period of time. Let's say if that's negatively geared by $20,000 over the course of a year, that means your cash flow is $20,000 less than it otherwise would have been. Now, even if you're in the 37 cents in the dollar tax bracket and you manage to get $7,400 of that back, you're still out of pocket $12,600 per annum, give or take. So if your primary goal is to reduce home loan debt as quickly as possible in the short to medium term, then debt recycling probably isn't for you, because you're likely to be negatively geared for as long, or for a long time, really, in most cases.
So it does then sort of beg the question, well, what's the point, Dave? But of course, over time, as rents rise, and let's hope the property value rises, the property will eventually become positively geared. And without that strategy, you might not have had an asset that had been compounding at 5 or 6% per year. So from a net worth perspective, that's where we can really kind of see a differential, right?
Yeah, exactly. And as you just touched on, and you're talking to the property managers about in Coogee tomorrow, that's where the growth in your asset values is so important. Whether it's your share value growing, your property values growing, that's a major part of the point of investing. You're putting money to work now with the expectation of the benefits that come later on down the track. And if the course of your period of time investing is ideally 10 years, 20 years, or even 30 years, you may be negatively geared for a long period of time. And so that, just as soon as you think you're going to start getting positively geared, well, then you buy another investment property, or, you invest more into shares. That looked like a knowing smile of someone who's gone through that experience, Mike.
You've triggered me, Dave.
Yeah. Trigger moment. See that look on plenty of clients' faces as well. Go into their next investment. But so look, at least until you stop borrowing to invest, or you are contributing cash towards paying down your investment purchases, it's likely you are going to be losing cash flow, which does mean you're not paying down the home loan quite as fast. And that's something, for people need to reconcile really as part of this strategy.
Yeah, agreed. Now, obviously, it's not a silver bullet. We've just kind of touched on that. There are some important downsides and considerations with debt recycling. Dave, can you talk us through those?
Yeah, so the big one, as we've probably alluded to now a fair bit, is the discipline of money management. And that is, the core tenet of being successful with our investing, full stop. It also obviously applies to if you plan to do this debt recycling strategy. So the strategy only works if the surplus cash flow and any tax savings are actually used to reduce non-deductible debt, because your surplus cash flow may actually be reducing because of your investments being negatively geared. So you do need to make sure that you are putting your spare cash flow into paying down non-deductible debt, and you stay disciplined with your spending. Otherwise, it'll
And
fall apart pretty quickly.
yeah, for sure. And you've got to understand that another consideration is just sheer complexity as well. You do need separate loan splits. You need to make sure you've got clean record keeping and have a clear trail of where the borrowed money actually went, because you need to have an answer to any ATO questions that might pop up on that. If it gets muddled, you can easily contaminate the loan and lose deductibility. And I went through a similar thing recently where I actually sort of had to say, sorry, could you just explain to me again, like what is connected to what in terms of these accounts? Because it can get very messy very quickly.
It sure can. And, look, I've, built a strategic mortgage broking business and spent a lifetime on this stuff. And I've still got confused with my own structures at times. So I could, as you just said, Mike, like it can get bloody confusing when you have multiple loans and offset accounts and different forms of investing.
Refinancing. Yeah. All of the, loan purpose releases. It's a spider web. And Ian's one of the most coordinated, clear thinking, ordered people I know. And file notes can only get you so far. I think there's so much to be said for avoiding complexity where you can and keeping things as simple as possible, because over the years, you only need one or two sets of refinances and you've already got something that does look like a spider web on a page.
Absolutely. And you have to go back to the refinance and like what loans paid out what and what did we do at that last refinance. It's also a bit of a side note, but why I love the idea of keeping loans straightforward, like one loan for each property, one loan for shares, one loan for a business, even if they are cross-securitized, because it keeps your loan structure really simple and easy to understand. But that's a bit of a sidebar because you can manage your buffers and risk through having huge amounts of cash up your sleeve, redraw up your sleeve, obviously life insurance, income protections, fixing rates. And that's why if you have reasonable equity, cross-securitizing I don't think is a bigger deal as people make. But I'll get back on track with what we're talking about today. So there's also a borrowing capacity issue that can arise. So, debt recycling assumes you either already have approved investment loan limits with investment funds waiting for you to redraw on them, or you'll be able to qualify for them and set them up each time, you pay off a fair chunk on your home loan. Now that in itself can be cumbersome. You actually want a facility in place. You don't want to have to be, setting up a new facility or extending it every 6 months.
And it's not always a given. So if you're up against a borrowing capacity ceiling and hitting your head on the roof of what banks might be wanting to give you, they generally don't ignore large loan limits just because the balance is lower. Again, like this speaks to the theme of the banks being the fun police, which is my normal gripe with the banks. They may also want to see surplus cash actually used to permanently reduce the home loan debt rather than sitting in an offset or a redraw before they'll consider increasing the investment loan, because they'll have all sorts of little algorithms to say, well, it's happy if X and it's unhappy if Y.
Yeah, exactly. So the fun police, they'll absolutely be all over it, which means you have to think carefully about risk management, which I was just talking about. So how much cash you keep aside as a buffer in your offset and making sure you've still got a buffer for when things don't go to plan, because as I say, often most people's largest risk in life is their debt. So your strategic mortgage broker should be talking with you, and you should be thinking about how are you managing the risk whilst carrying your debt. How do you manage the risk of carrying your debt?
Well said. So if we circle back to Hunter's question, we've said before that home loan debt with redraw is generally non-deductible. Dave, can you unpack that a bit more?
Yeah, sure. So the most common scenario we see is where someone buys a home, works really hard to pay it down, they make extra payments, and those extra repayments sit in redraw. Years later, their situation changes. They want to upgrade their home, but they want to keep the existing home and turn it into an investment. Now, what happens is their home loan's really low and they think that's not very good. I'm not going to get many deductions, but I've got heaps of money here sitting in redraw. I'm just going to redraw that money out and claim the total balance as a deduction. But you can't do that, unfortunately. Once you've paid down a debt, you never get the chance to redraw it back up and claim it for the original purpose. So that's why you should always be mindful of ever paying debt down. Is there any chance this debt could be investment, be an investment into the future? So where does that money go when you redraw it? Well, in that instance, they've got all this cash. They'll then use it to go towards paying for the new home. So it isn't deductible. And worse than that, they've now got a loan with mixed purposes of deductible and non-deductible debt combined, which is an issue.
The loan balance is lower as well, so the potential tax deductions will be lower in concert with that. And that's where the question about redraw usually comes up, right, Dave?
Yeah, exactly. So people then ask, can't I just redraw the money I paid off to increase the loan balance again, as I just described, and claim the interest on the full amount as a deduction now that it's an investment property? But as I just went through, the answer is no. And, so ultimately each time you redraw, whatever you then spend that money on determines whether it's deductible, not the loan balance or the property it sits against. What did you go and spend that money on when you redrew it out? And you don't want to be redrawing for investment purposes from a home loan or redrawing for non-deductible or consumer purchase purposes from an investment loan, basically. So, we're talking about this on the podcast, but the reality is that even when it's explained in a one-on-one meeting, most people require discussion, the ability to ask questions, and confirm clarification of understanding for these concepts to really land. Even then, an experienced strategic mortgage broker will understand that we often need to revisit these concepts with clients down the track, and that's completely normal. I mean, we all have enough going on in our life, and to remember everything, so when we seek advice from professionals of any kind, we're not expected to remember everything they tell us. That's why they are the experts. So we don't always retain every technical detail, and so it's important for people to reconcile that for themselves as well. They'll listen to this episode, but they won't everything will necessarily make sense to them, or they'll have perfect memory recall on it in 2 months' time.
Yeah, fair point.
Well, you just sort of said yourself, Dave, that you can get confused, and that made me kind of think, gosh, if it rattles you, like what hope have mere mortals like us got?
Yeah.
Yeah. Question.
Yeah. Bank accounts, loan accounts, redraws. It just can get confusing.
Yeah.
For all us
question
mere
for our resident tax nerd, Mike. Can you explain why it doesn't work from a tax point of view?
Well, the key thing to understand is the ATO's purpose test, right? So it's, I suppose, expanding on Dave's point, redrawing money back out of the loan isn't undoing the repayments that you've already made. Really, it's going to be seen as new borrowing, and then the deductibility of that redrawn amount depends entirely on what that money is used for. It needs to be an investment to be able to be deductible, not a jet ski.
Yeah. So in simple terms, you just have to follow the money trail, and the reality is the ATO can do that. They can go and look and see, okay, here's a redraw from your home loan in this account, and that was $27,550. Where did that land? Okay, that landed in this savings account. Okay, and then what did that savings account next spend money on? Oh, groceries, clothes, So it's not that hard to follow. So you just want to be conscious of where that money is going when you access redraw.
Okay, so final question on this. How is that different to a debt recycling scenario?
So, yeah, the key difference is intent and structure. With debt recycling, you deliberately set up a separate loan or loan split from the start, specifically for investment purposes, with the intention that any money drawn from that loan will be used to buy investments while using spare cash to pay down the home loan. And generally, the idea is that your total debt levels remain the same.
And importantly, that's very different to redrawing from an existing home loan. In the redraw scenario, you're borrowing again from a loan that was originally set up for your home as non-deductible. And the purpose of that redraw depends entirely on what you spend the money on, as we've mentioned a few times.
Yeah, so we're really labouring a few of these points, but you're not undoing repayments or trying to revive old debt. You're creating new borrowing for a clear investment purpose, rather than redrawing money from an existing loan that was set up for personal use.
All right. Well, that brings us to the end of today's episode on debt recycling. Hopefully this has helped clarify what debt recycling actually is and how it works in practice. And just as importantly, when it doesn't work the way people expect it to. Thanks again to Hunter for your great question. We always appreciate a question that prompts an episode. So to everyone else out there, if you've got a topic you'd like us to cover or scenario you're not sure about, just feel free to get in touch with us and let us know. We have a lot of listener questions that have come in and we'll try to get to as many of them as possible. And as always, thanks to Dave and Mike, and especially Dave's team for making a complicated topic so much easier to understand. Don't go anywhere just yet, though. Our gold nuggets are coming up next.
Now it's time for us to go mining for our gold nugget property tip of the day.
Yeah, so as we've talked through, a big takeaway for our listeners today is debt recycling is a great idea because it gets you investing, but it's not a magic trick or a shortcut. It's a strategy that needs to be set up intentionally and from the beginning with the right structure in place. It relies on discipline, a clear understanding of your cash flow, your risk tolerance, and your long-term goals. It isn't a way of cheating the system to pay down your home loan. In fact, it may mean you do this more slowly. It's not a tool to undo past decisions or mistakes, and it's definitely not something to jump into without getting the right advice. So the primary focus is to get you investing over your life, consistently investing. And if you're sitting there wondering whether the way you've been treating your mortgage might actually be holding you back and your long-term financial position, or whether debt recycling is something you'd like to explore in more detail, feel free to reach out to our team and you can have a chat with one of our strategic mortgage brokers. So, but yeah, that's my summary and gold nugget for today.
It feels for me like this is sort of like spruiker fodder, this type of topic. There's parallels between this and the family trust, unlimited borrowing sort of stuff. But the reality is that it's complicated, and making one incorrect decision can saddle you with the wrong debt structure that could actually be quite problematic for you in the future and certainly limit the potential to grow your portfolio. So I would just caution people to not go into anything without getting the advice of somebody like Dave, because the implications are too big, and we don't want to be raising the ire of the tax office, and we don't want to be limiting our ability to grow our assets and our financial freedom.
Nicely said. I've got a gold nugget as well. There are two reasons in my mind that shouldn't be leading someone to debt recycling. The first one you touched on, Dave, when you've made a boo-boo and you want to fix it. Some mistakes when it comes to tax deductibility are unforgivable and you're stuck with it. The other reason is if you're thinking it's a cool hack to avoid the annual or the quarterly or whatever the fee is for having an offset account. It's not a cheap alternative. You've actually got a lot of other work on your plate if you're not wanting to pay for an offset account. I can't stress highly enough the importance of an offset. So debt recycling has its place, but it shouldn't be a buzzword to avoid paying a fee, which is deductible anyway in the scheme of things.
Mm. Yeah, absolutely. If you've got some idea of debt recycling and using redraw and you don't need an offset account, well, you've certainly got the strategy all wrong. Then let up the garden path.
Agreed. Well, that was an awesome ep. My head's still spinning. It was great though. So I think for anyone that listened to it and their head's spinning, give it another go. This is one of our shorter eps. We've just clocked around half an hour. And Dave, thanks to you and the team. It was a ripper.
Yeah, thanks to the team. And, it does have me thinking. Remember, we were like 20 episodes in, you and I'd catch up and go, what topics are we going to do? We're going to run out of topics. We're like at episode about 350 and we're still coming up with new topics.
Yeah, we had a really good question a couple of days ago. Someone was asking about reverse mortgages. We've got a really good bank of great topics. So keep them coming. And we hope to see some of you at the live. I'm loving the people that have reached out and registered. Looking forward to meeting lots of new best friends.
Yeah, that'll be awesome.
Can't wait. Going to be a fun night.
Well, I look forward to seeing you fellas next week.
See you then.
See ya.